Believe we got 10 or so stocks here to go over. Why don't we mix it up a little bit today and go with the stocks that are moving the most? So let's jump in here with Gap. What does New Constructs have to say about Gap? Neutral rating. The ROIC is kind of low, I would think, for a retail company. That's about right. You're not going to expect a lot there, but it's good to see economic earnings that are positive and on the rise, a strong free cash flow yield. And this is a pretty low price to economic book value for a market implied gap that is 50 years. So that's interesting. That's interesting. I'm guessing that maybe margins are probably coming up a bit, and we're not giving them all the credit for that margin improvement at this time. You see return on capital pretty strongly improving here. A lot of that's probably driven by margins. And we're going to look at probably an average around this last whole period. So our margin is probably a little bit lower, which means it's going to take a little bit longer to generate the cash flows embedded in the stock price because that cash flow would be generated at a somewhat lower margin over time. Free cash flow yield, good and steady. These guys have been good free cash flow, good company, good boys here, making good cash flow. And then economic book value, been pretty volatile with the NOPAT margin. We can see here, though, that economic book value is on a pretty strong rise. The stock's been, I guess, those who follow it, really flat for a while. But today, big day, up 3% for Gap. That's a big, I'm sorry, up 17%. That's a big number for Gap. I mean, we got 1948 and we're up to $22. So that's a big number. It seems it must have outperforms as EPS surges by 10.2%. I think they gave some good guidance around tariffs, which was counter to what we saw from a lot of the other retailers who are down still. And that's interesting because Gap's been kind of a struggling company. So I think the takeaway for Gap here for you all is neutral rating, but if you feel like the business is going to continue to improve, then this would be something worth taking a closer look at. This would be worth something taking a closer look at. Not the best financials, but a pretty cheap stock. Pretty cheap stock. Nothing too funny going on and hidden items here. Pretty small, going down, not up. Earnings distortion getting better. We don't like to see accounting earnings crossing over core earnings because that hadn't happened before. So that's not great, but it's a pretty small amount. We don't have a strong miss rating here. So I'd say for Gap, we're doing pretty well. All right, what's our other big mover today? Broadcom. This is it's gonna be one of my favorites. We're gonna get a little bit deeper into Broadcom because we've seen this stock jumping up like crazy on the heels of NVIDIA doing so well. And it's like, oh my gosh, we made, so much money went into NVIDIA that it was like, we need to put some money into something else. And I think Broadcom was the beneficiary of that. I don't know that its valuation needed to go up as much as the stock price has gone up here recently. But I believe that Broadcom beat the numbers and the AI trade isn't dead. I mean, this is sort of one bright spot in the market for those of you that are the Momo types and looking for this kind of big momentum that we've seen happening to continue. This is not a very good business. Like the difference between Broadcom and NVIDIA is, these are both bright green. So it's for NVIDIA, good business, bad stock. Broadcom, mediocre business, bad stock, which means extra bad stock. 8% return on capital because these guys have a really bad history of write-downs, I believe. This is the company I'm thinking of. Yeah, you see accumulated write-downs. They've done a lot of acquisitions. It's a 1.2 billion. Not a big amount in terms of total adjusted capital. So maybe I'm not thinking about the same company. I know the old Broadcom had a lot of bad acquisitions over time. But this is a more capital intensive business than NVIDIA, whose returns are much higher. Let's see here. Economic earnings down. We got the 10K, so that was a big drop. I don't know, whatever they beat, it was probably a lower number. And those of you who've been on this call with me before, how Wall Street plays the game with their numbers. But the stocks they like, they have lower estimates, so it's easier to beat. Stocks they don't like, they have higher estimates. And they use a different model for coming up with target prices. So earnings estimates from Wall Street our game, their trick. I would not pay attention to them. Yeah, return on capital coming down a bunch here. Margins down, capital turns down, free cash flow. Yeah, big acquisition here recently. That's not helping returns on capital at all. Okay, yeah, here we go. Yeah, this is 70. Yeah, they had a huge acquisition. So this TTM in 2024 are the same because we just got the annual report. So I missed this before, where we've got 70, from 73 billion to 166 billion in total assets. Invested capital goes from 53.6 billion to 143 billion. So an even bigger jump there. So it looks like they put some of this hot money to work and made a big acquisition. Yeah, VMware. That was a super expensive stock that we watched for a long time. Thanks, Neil. That was the acquisition they did. And yeah, so I bet they overpaid for an already expensive stock. And that's just going to crush your return on capital, crush your cash flows. It's just not a good sign. You want the agents of your capital. We're the owners of the capital as investors, right? We are owners of capital, and managers are our agents. They're taking this capital and they're supposed to do good by that. That's the purpose of the capital markets. That's the fundamental idea behind a democratic capitalist system, is that we want that capital to go its highest and best use, just like we want the best ideas to rise to the top. That's part of why we have freedom, because if we don't have freedom and we don't let the market, we don't let the group do its own best work, then it's effectively centralized. If it's not decentralized, it's centralized. There's no way to do it. Either you have censorship or you have no censorship. There's no partial censorship, because at any point in time, if you're putting somebody in charge of censoring or determining where capital allocation goes, you are ruining the ability for society to determine its highest and best use. And that just comes down to one person or some group of people. And that's not healthy. And part of the reason the United States is where it is today in terms of being the global economic superpower is because our capital markets are better. So let's take a look at Broadcom. I think we looked at this before because it was so expensive. So I got a couple scenarios already put in here for what's required to justify the current stock price. Now we see returns on capital really haven't been that great anyway. I think we go back here, we saw it got crushed down to 8%, but return on capital before this, it was only 24, 28%. Nvidia's return on capital is 211%, right? So it's a lower quality business even before the acquisition. So let's go. We got a couple scenarios here. If we assume 21% compounded annual growth in revenue for 12 years and an improvement of the return on capital versus cost of capital spread from -3 to +34, that will justify about $180 a share. On the other hand, if we think about a slightly lower growth rate and lower level of profitability, it takes 60 years to justify the current stock price. So it's just, that's the way it is, right? If you're going to grow fast at higher margins and more higher return on capital, you're going to generate free cash flow faster. That means you're going to achieve the cash flow growth expectations embedded in the stock price more quickly. Growing faster, you're going to go make that money faster. And so that's why we got a lower slope and it takes longer. Steeper slope happens faster. So let's take a look at what the implied revenues are here. Wow. All right, so we can see a hockey stick for that optimistic scenario. That puts us at 502.4 billion. If we want to look at total revenue and sort the S&P 500 by largest to smallest, we can see the biggest right now, Walmart, 674 billion, and these guys are expected to be 502.4 billion. Where would that rank in the S&P 500? This is data that I pulled back on February. We could update it any time, but I think it's close enough, right? So they'd be number 3 in the S&P 500. What would the NOPAT be? It would be 150.2 billion. Let's see, the NOPAT rank. Shoot. NOPAT 150.2 billion. So that puts us, that would be way bigger than any company in the S&P 500 right now. Wow, a lot bigger, like 50% bigger. That's impressive. The return on invested capital would be up at 80%, and that would rank not quite as high. That would rank, yeah, top 9. So I think the takeaway here is that Broadcom is quite expensive. You can see return on capital's kind of had a bumpy road. They've never been that good, but this is like rocket ship, no pat, hockey stick, right? We're at around 10 billion in OPAT, and we're going to go to 150 billion. That's a pretty good growth rate. And revenue, hockey stick, to 502.4 billion. So I think this means that it's pretty clear that this is a really expensive stock. We would recommend you stay away. I do not consider this a good investment. I think expectations are super high. And keep in mind, to own the stock at this level, and let's make a quick note here. The stock's at 179. We were looking at 179. Okay. So, well, let's see. The stock is actually at 193. Sorry, it's at 193. We're looking at implications at 180. So it's already gone up a lot. And what you need to understand is that in order to own the stock at 193, and we can look at the implications for when I just the point is to be significantly higher than what it is now, right? To own the stock from a fundamental perspective, from a truth perspective, from a non-FOMO narrative, whatever crazy driven, you need to believe that the company's future financial performance is going to be materially greater than what is already baked in. That's what justifies owning a stock. You got to be materially greater than what is already baked in. You got to expect the company to do materially better than what is already baked in. Otherwise, there's no reason to own the stock. The market's got the valuation right. Mr. Market's got the prediction right. So that's what we're dealing with here. When we say bad company, good stock, or bad company, bad stock, that's kind of what we mean. Or good company, bad stock. Expectations are super high here, super high. Incredible growth rate implied here for profits. We would recommend you go someplace else to find a good stock. Okay, Macy's. It's like Macy's had a good quarter, revamping stores, closing others. This is smart. We love it when we see capital consolidation, when companies go in and say, let's clean up the books. Let's shut down the bad stores and reallocate resources to the good stores. That needs to happen because oftentimes when businesses are doing really well, look, they're trying to grow as fast as possible and investors are pushing them to grow as fast as possible. You got a good thing, you got a good thing. Let's make the most of a good thing as soon as and as fast as we can. Problem is that oftentimes you end up overdoing it. You overbuild and you end up having a lot of stores that eventually don't do that well. Sometimes you have stores too close to each other. I know we often wonder about that with Starbucks, right? There's a Starbucks everywhere. There's a Walgreens everywhere. They probably need to have some attrition. So interesting. Forecasts 2025 sales and profits below estimates on inflation, tariff uncertainty. Interesting. They expect sales to drop again this year. But let's see. Stock's down net over the last couple of days. So what we're seeing today is a bit of a bounce back. Kind of flat on the month, really down over the last 5 days. Today's kind of a bounce back. I guess it's kind of a bounce back for the market in general, at least a small bit. But yeah, I think it's fair to say that Macy's having a big day. What does our system say about Macy's? Well, I was expecting a strong beat. It's super cheap. So this is a great example of where they came out with a miss or bad expectations for the future, but the stock price is implying worse. You've got a price to economic book value here of 0.5. That means the stock price is implying a permanent 50% decline in profits. And I think Macy's came out and said, yeah, it wasn't so great, but it's not going to be 50%, maybe 5 or 10, right? So the stock's got room to come back, which is why we saw the decline followed by a pretty quick bounce back. That's the beauty of our system is that, when you get into stocks that are super cheap, right, they've got a lot less downside. They got a lot less downside risk because the valuation is already so pessimistic. The implications of the current stock price are already so pessimistic. So yeah, what's going on with the business here? Imagine returns on capital, economic earnings kind of leveling out. Bad time during COVID, came back a little bit. Nothing special here. Same with, return on capital looks exactly the same. Margins, wow, everything kind of looks exactly the same. But, this is a great kind of example here of where, yeah, the business is in decline. Is it a 50% decline? No. And so the stock price is cheap, right? Bad company. Oops. This is bad company, good stock, right? You probably never heard anyone say that before, but it's possible. You can have a bad business, but if the stock price is implying the business is going to be significantly worse, materially worse than what you think it's going to be, well, then it can still be a good stock. And here you see, you've got decent free cash flow, a stock price that implies a permanent 50% decline in profits. And look, this is one you don't need any growth. You don't need any growth appreciation period if the stock price is implying a permanent 50% decline. Anybody have any questions about what I'm talking about when I go through the valuation stuff? Because I've done it so many times, and I sometimes I may go fast, but I want to make sure people understand this because I think this is incredibly insightful stuff. If you care about fundamentals, this is the truth. This is what's going on. This is what the stock price implies. This is why fundamentals are helpful because you have a real footing in strong math, reliable foundation. And I think that that's a good way to go. We got free cash flow wise. Pretty good. Been negative here, but pretty positive here. So yeah, this is going to probably, they're closing down stores, so they're hopefully maybe raising some cash as they consolidate and get smarter about where they're allocating. But overall, pretty strong free cash flow here. Way more free cash flow, positive free cash flow than we've seen negative. So this has been a net free cash flow positive business. That's why you're getting that 2-year average free cash flow yield of 5.4%. Not bad. Not bad at all. I would also highly recommend that if you have not been a part of our community before, you would join that. We've got some great conversations about forecasting, forecast metrics, how we do that. I wanted a lot of detail here. Almost should go through this for today, but just explaining how our model works, right? When I'm talking to you about AVGO, you need to know, like, well, what are the inputs? How do we come up with these inputs? How do we come up with a default scenario? How do we come up with a default scenario for revenue growth? How do we come up with a default scenario for the pre-tax profit margin, for cash tax rate? I explain all that in the community. I'm not going to do that today because it would take a long time, but I will sum it up to say that our default forecasts are based on consensus estimates for revenue. And then for everything else, we're looking to do a conservative extrapolation of what the company's done in the past. We're not trying to predict anything crazy. We want to just extrapolate so that we can more easily and quickly and clearly delineate those stocks that are expecting or implying a significant improvement or significant decline from the existing. That's the idea. That's where we find the abnormalities. That's how we shine a light in the dark corners. It's looking at the fat tails, not looking at what's under. So that's what we think about Macy's. Bad company, good stock. All right, we got a lot to get through here. Should probably get going a little bit faster. Any questions, let me know. As always, let's see. Kroger. Yeah, this has been, man, so it's up pretty strongly here past 2 days. One day. Mixed quarter and soft guidance. The stock rises anyway. What does New Constructs have to say about Kroger? Attractive stock, decent company, cheap stock. So what happened? Does it really matter what happened in earnings? Let me tell you, like, I still, to this day, I remember when I first started to understand the earnings game on Wall Street. And I thought, okay, so everybody's obsessing every quarter about a penny here, a penny there. I mean, at most a nickel here, a nickel there. And as if that penny or nickel is consequential to the future body of cash flows that have to be generated to justify the price. It's silly. It's silly. We were just talking about companies meeting or beating or missing, and then we go through AVGO here and we look at the huge amount of future cash flows required to justify the price, and we're going to get excited about a penny a nickel. Come on, like, what are we doing here? It's going backwards. It's so misleading, and it's purposely misleading because if Wall Street can get you to focus on that, they can get you to not focus on the bigger question, which is how much future cash flows are baked into the stock price. So Kroger's looking pretty cheap here. Yeah, I know that they had this merger go down, and there've been some questions about the CEO. I think there's even some articles written about that by our buddy Matt Levine. And So yeah, Kroger is such a big, sprawling company. And I actually worked at Kroger. It was my first job out of college. I was in the management training program. It was an excellent education. Took me about a year to realize it was not going to be the career path long term for me that I wanted because their promotion cycles are really slow. But I would tell you, I would not be worried about a CEO. I mean, I think when I was there, they had a different CEO and things changed there at the top. That's a really big organization. CEO is not going to make a big difference, good or bad, unless it's really drastic on one way or the other. So, yeah, Kroger, yeah, it is. It's been in the focus list for a while. We like the stock and, we love it. And I think it's a tribute to the system when stock's getting an attractive rating and it goes up, even if its earnings aren't great. But Locker, I wanted to hit on some retail stocks today because I just think retail is interesting. So what had happened to Foot Locker? The best of the year, the prices fell out of weight, stocks recently. Looks like Foot Locker beat up a lot here recently. We predicted that. Strong beat. Good for us. That's great. Not such a good company. Stock, I don't know. This is interesting. So price to economic book value of negative 3.4 with a less than one growth appreciation period. Both economic earnings and accounting earnings are negative. What's going on here? I'm guessing we got a bunch of debt. Yeah, big debt number. 3.8 billion on market cap of 1.7 billion. Ooh. So that means even though they got a positive NOPAT, right? You got a negative net income, but a positive NOPAT. So that's interesting, folks, right? They got a lot of non-operating expenses dragging down net income. Invested capital, you got quite a bit of write-offs. They've not done a great job. Got a bunch of off-balance sheet debt, 1.8 billion in off-balance sheet debt. That probably contributes a lot to the debt here. That adds another, yeah, it's almost half of what they're reporting their debt to be. A good bit less than half, more like a third of what their debt is off-balance sheet or misrepresented. But still, you got a pretty decent amount of capital. You got 1.4 billion in write-offs that we had to add back. So the NOPAT's positive, but the economic book value is negative. See returns on capital, NOPAT margins kind of trending down here. Free cash flow. Okay, not too bad. Not great. Got a decent yield. 4.5, 4.7. Economic book value is on the slide here. Interesting. Wow, really high. 180 bucks, 65 bucks. On the decline here, though, as of late. So I would, yeah, I think it's tough to be in one of these retail businesses. So I'm not inclined to look to make a bullish case here for Foot Locker. But yeah, you've got a lot of debt. But if the margins revert back, which is our model, our reverse DCF model is going to probably be looking at average margins over this time frame. So our forecasted margin is going to be more like up here. And I'm guessing if you assume margins get back that high again, you're talking about, you're talking about a profitable business real fast. It's a very margin sensitive business. Small changes in the margin will have a big impact on stock price. So you believe they're going to make a comeback. More power to you. All right. We got next here. BJ's Wholesale Club. Looks like they had a pretty good earnings release too. Looking good. They're up 13.4% over the last couple of days. That's impressive. So it went from unattractive to neutral. Let's see. When do we get the last filing? We're getting a filing any day now here. Okay. So that'll be interesting. A lot of this might change. Lower market expectations. Seems like the opposite for an upgrade because the stock's been going up. What's going on there? I wonder if the forecast was changed or something. So BJ's, not a great company, not a great stock. This is one of those I kind of wouldn't mess with it. I don't see a lot of action here. I don't see something that's saying a lot of overpriced, a lot of expensiveness, or a lot of cheapness. Just kind of there in the middle, which is not very interesting. Wouldn't play around with that very much if I were you. Venture Global up 1.8% or 1.9%. Okay, so it looks like it's been up and down. Oh, okay. Whoa, okay. Over the last couple of days, it's down 39%. Interesting. Class action suit, seeking recovery. Stockholder losses. Oof. Getting sued. Not a good thing here. What are we showing about Venture Global in our system? Okay, we're gonna get a new 10K. We just got this thing just kind of went public pretty recently, just added a coverage, and it's already blown up. That's not great. I think this Venture Global is a big natural gas pipeline. Yeah, we were looking at this. Oh, interesting. I remember when it first was coming out, in our meeting, our analyst was telling us about how expensive this IPO was going to be. It was going to be like one of the biggest IPOs ever. And they brought it way down, which is good, but it appears it's still quite expensive. Let's see. Let's dig a little deeper. You don't have a lot of data here. So economic earnings appear to be positive and rising, but we don't have a lot here. 89, 108, You just got one period really because oh, that's the big thing I forgot to mention. They haven't given us any 2024 data. So the last data we have is 2023. We almost didn't cover it, but we're like, you know what? We're going to go with what we got. It's all anyone else has. So let's figure out what we want to do here. I see. We got some good information. Yes, recent IPO. Management guided down 50%, and the stock price is implying another 40% decline. So maybe it's cheap now. We're pretty bullish on the energy sector, as you all know. It's not much fun when you don't have a lot of data. Free cash flow, negative. Yeah, so we got that. Price to economic book value. So the stock price plummeted. Wow. So before that, expensive. What a huge change, man. What a huge change. What a huge change. Economic book value is around $16 a share. The stock is now at $9. You know, if it had more history and I was able to, if I was an energy sector analyst, by the way, the energy sector is one of our top rated sectors, has been. See, this changes every day. Yeah, very attractive still. But yeah, if I knew this sector well and I thought these guys are going to be able to be a great going concern, I think I'd be looking at getting into this stock because it's likely that it's going to not it's got it down 50%. Now it's down. Now the stock price implies another 40%. I just don't think we're going to see that much permanent value destruction for energy companies. There's going to be some reshuffling of the global landscape here, but I think ultimately it's going to be more beneficial to the U.S. producers than not. Yeah, great comment here from Curtis. A 50% guide down on EBITDA 2 months after an IPO, unheard of. You all have listened to us for a while. You know how we think about IPOs. I mean, so many of these are ripoffs. That's why we cover them because they're like crazy expensive stocks half the time. We've been really negative on most IPOs. That's why we want to cover it. We were the ones out there who were first to call out WeWork. I take credit for a lot of credit for WeWork getting canned altogether. And one of the big changes we saw after the WeWork IPO was that the amount of time between filing their S1 and going public was dramatically reduced. When we got the S1 for WeWork, we were able to publish a report, and it was months before they actually went public. And so our research got to make a lot of rounds. We were on Forbes, calling it the most ridiculous IPO of 2019, and we were right. And that made the rounds. And I think that's probably part of why we saw the decline or the end of that IPO. Didn't happen. And now, you know how much time we get between the filing of the S1 and the IPO actually happening? It's like 2 weeks as opposed to 3 to 4 months. Right. And sometimes like they do these fake filings where they file an S1, but they don't put any financial information in there. It's like, what? So I think Wall Street wasn't happy with what we were doing. They, if there's one way to give us less influence, like a lot less time for our message to get out there. So yeah, as much as this is a tragedy for IPO investors, and don't get me wrong, this is a tragedy. Curtis is right. Like to guide down less than 2 months, like all of a sudden your opinion of your business changes that much. Yeah, I get it. There's a lot going on with Trump and everything, but I still think long term, this is going to be more good for the US than bad. But yeah, pretty nutty. Pretty nutty. Pretty nutty. All right. Who's next? National Beverage Corp, FIZZ. What's going on here with the earnings? Anybody know what happened here? It looks like his stock's up more than it's down. Looks like a little bit of confusion from yesterday to today. It started. So some noise in the stock, but not a lot of overall movement. We got a question here. Isn't it possible there's some short covering today given the market turnaround? It could be technically driven. Absolutely, Frank. Like There are a lot of short-term currents in the market pushing it one way or the other, driven by a lot of different things. And so, yeah, it could be. What does the model say about FIZZ? We're getting a new queue any minute now. Could have come in earlier today. Who knows? We've got great, great company, bad stock. We were forecasting a miss, which I kind of what I'm seeing here looks like that happened. So I would say that yeah, this would be one to avoid. There's not a big moat around a business like this. Soda is a tough business. It's about distribution and branding, and that's where size matters. And that's kind of what Coca-Cola and Pepsi do are the kind of the 300-pound gorillas. You got to have something special to like catch on, make your LaCroix or Shasta more popular. You got to take share against people that can spend heavily to retain share. So yeah, I'm not seeing a lot to like here. Return on capital pretty high and flat, good, that's good. That's good stuff. Good stuff. Like I said, good company, bad stock. What do we got next here? Cracker Barrel. We really wanted to put this on the focus list at one point. We had a lot of conversations and we couldn't do it. Couldn't do it. Just couldn't really see the growth long term. Small stuff. We're about to get a new 10K here. Mediocre business, bad stock, expensive. Yeah, it's always been a little bit too expensive for us, and we just don't see it. I mean, fast casual, great, but yeah, it's not attracting a lot of new trendy crowd. I mean, Cracker Barrel, I think you've got your staple people who like it and who will go there and will always go there, but I don't know how much they're growing or going to grow. And I think it's the high margin stuff that they have you walk in and walk through to get in and out of the restaurant. That's great, but like nobody's like pulling off the interstate to go to Cracker Barrel, especially when you got these Chucky's. What's it called? The new Beaver place that's so popular? Bucky's. Yes, like people love that place. It's great. It's big and huge and nice. They did raise the prices too much on the brisket, so I'm not doing that anymore. I did love that. I loved it. Like being able to stop at a place and like they've got like meat. It's great because I don't want to eat a bunch of that packaged stuff. And it's a good store. They got all kinds of stuff. People love it. I mean, like I remember I first heard about it from my kids. They were on a wrestling road trip. They're like, "Oh, we stopped at Bucky's, Dad." I was like, "Okay," and that's a big deal. For what reason? Anyway, people love it. They got a lot of cool stuff there. I actually bought some. I stopped there on a drive to a big wrestling tournament. Picked up some charcoal. It's great. It was really cheap. I'm like, shoot, I'll take this. Anyway, besides that, they definitely have much better selections on food. If you like roasted nuts and all that, they got great. Like beef jerky, they got tons of that, which is great. And everything else. It's a big, huge, beautiful store, and they got tons of gas station things. And I think it's pretty cool. I'm on the road, like I want to get in and out as fast as possible. So it's not always my favorite, but still cool. But I don't think Cracker Barrel is going to compete well against Bucky. In general, it's a mediocre experience. I think it's pretty inexpensive. It's got its shtick, but its shtick is not going to do anything close to helping the business grow like what's baked into the stock price. So avoid this one. All right, our worst moving stock of the day, JD.com. Okay, so over the last couple days, doing just fine. So this is kind of just noise, but a net move. They top revenue estimates on robust demand and government stimulus. Waivers despite China e-commerce giant posting best sales growth since 2022. Why they rallied on Wednesday. So, we've been burned by some Chinese stocks at new constructs. There was a time we were covering some of these a few years ago, too many of them, and they all looked really good. Like, what's going on here? Turns out they all had fake accounting, fake auditors. And so we're skeptical. The more research I do, sort of on, you know, where China sees itself in the global landscape, it makes me concerned that putting money into those businesses, if it suits China, it's probably going to be China that makes sure they get those profits as opposed to US investors. So trade these carefully. Trade these carefully. Strong economics. Look, if you're chosen to be one of the companies that does well in China, you should have strong economics. Of course, we should be getting a new filing any day now. I should have got it yesterday. So but any day now. But yeah, strong economics, market implied growth appreciation period is really long. I'm guessing that's because you've got the margin going up. Yeah, so you got return on capital. So our margin, our NOPAT margin is going to be a little bit more of like a weighted average of the last 3 years. So it's going to be through this. So we're probably like right around in here. And that small drop in margin, it's indicative of like, okay, well, if that's happening, well, now it becomes an expensive stock. And that's what you see with a lot of kind of retail type businesses. Small changes in margins have huge impact on valuation. So you really need to focus on that, which is part of why you hear Wall Street talk about that a lot, margins and earnings and things like that. And that is important. And oftentimes it can be very impactful to the valuation. It's also important to be packaged with sense of growth and duration, right? The three key drivers of value, right? How fast is the business going to grow? How profitable is it going to be? And for how long can it sustain profitable growth? Those are the three things you need to understand to quantify the expectations baked into a stock price. It's free cash flow, been pretty negative, more negative than positive on balance, I would say. Because these 2 years get canceled out by these 2 years, and this is bigger than this. So yeah, it's zero free cash flow overall during its time. Capital turns headed down, margins headed up. Yeah, I'd be careful with anything in China. I think things are going to get more tense. I think it's likely that the United States is going to have to take a little bit more of a sober view of China and how we work with and compete with them in the future. Okay. All right, we are about to be done here. So if you've got any requests, you better get them in here fast. I think I got one that I'm going to go into here. And Carter's. Oh, this is a baby company. This was on our focus list at one point. It was a long idea, and it did awesome. This baby gear company, like a Toys R Us kind of, but more for like baby gear. But this looks cheap, man. This is something to be considered. It's in our Savus dividend yield model portfolio, 0.5 price to economic book value. Market children's apparel. And DL saying it's online and brick and mortar. We like that. We've been a big fan of that. We think the omni-channel is the right way to go. If you're smart, it works out well together. Amazon moved to that. That's why they bought Whole Foods, right? Williams-Sonoma crushes it on that. And so, yeah, this is your bonus today, folks. I would tell you this would be something we should consider for our focus list. And this is like a really, really cheap, like 18% free cash flow yield, 0.5 price to economic book value, online and brick and mortar omni-channel. Thank our friend DL for pulling this out here for us. I like this stock. Return on capital, good and steady. Look, again, you're not going to expect something out of the park here. You want steady. Steady is good. This is probably just some noise here. Went down, went back up. Because people couldn't shop that much. Economic book values come down, but it stayed, it's holding steady, but the price is way down. This is a great example, I think, of a market where, we're going to go throw good money after bad with Broadcom because it's popular, and yet a stock like Carter's, is not getting any love. So, all right, well, thanks very much for being with me today. Great. Again, this is our last session for this quarter. Next quarter, I think we're going to do a lot more of these for clients only. They won't be free for everybody. We'll do a couple free ones. But if you really like this and you're going to want to join us every time, it's a good idea to sign up and get access. I hope you enjoyed the demonstration of our institutional tools, our professional tools, and the insights. And it's been a good series. Yeah, thanks, DL. I've enjoyed doing it. I'm looking forward to doing it more in the future. I got somebody raising their hand. You need to put it in the chat, Richard, if you want to say if you have a question or something. But thank you, Richard. Yeah, this has been fun. I look forward to being with you next quarter. I hope you have a great weekend.